Great. Okay. Welcome, everybody. Good afternoon. Hope everyone's staying safe and healthy. So this, of course, is going to be a presentation on technical analysis and investing using technical analysis, but I just wanted to say a word or two about what's going on. I got muted. Can you hear me now?
Yep, we can hear you.
Okay. So just wanted to say that, investing is good and everything, but what you do with your time and investments is also very important. And one of the best things you can do is invest in your community, invest in your future. And so that's why I just wanted to mention that, this is kind of a historic moment for the farmers in India, especially the Sikh farmers and the Sikh community. So I know many of you are involved with that, and I appreciate that, but I just wanted to mention that I hope that you will be cognizant of what's going on and support them. Okay, so having said that, let's move forward. So a little bit about myself. I've been an engineer for 30 plus years, and I worked in various different fields, everything from telecommunications to fiber optics to aerospace. And I'm currently working for a large defense contractor. Now, throughout that time, I had the privilege of once actually working for a startup company, and the company went public, and the stock price went from $25 to $125 within a matter of days. And it was the most incredible thing to witness. However, it was during the time of the dot-com boom. And we went from $125 to $1.25 in a matter of months. So I experienced that whole emotional roller coaster of, going from being a multimillionaire to a thousandaire in a short amount of time. But what it did teach me, though, is the appreciation that there is tremendous amount of money to be made in the markets. But in order to do it, you need to have techniques, you need to have a process to do that right. So I've been investing and trading in the markets for 10, 15 years, but really it's the last 5 years that I've gotten any kind of consistency. And that's because I've been studying a little bit more technical analysis, and some of the techniques I've learned. I'm by no means an expert, but the few techniques that I've learned have worked well for me, and I'm happy to share those with you today. All right, so here's what we're going to do. These are all the items we're going to cover. We'll do a quick recap from the previous presentation that Dr. Manmohan Singh did on investing. And then we'll dive into technical analysis. Now, just wanted you to be aware that in order to do technical analysis, you need to understand calculus and differential equations. And how many of you have that background? I'm actually just kidding. You just need second grade math to be able to understand technical analysis. It's no big deal. And if you don't understand second grade math, I think Arjun will be happy to tutor you. Right, Arjun?
I'm happy to tutor you. I don't think I could do it well.
You'll be fine. So essentially, technical analysis relies a lot on price charts. So we're going to go over the basics of price charts and how to read those for stocks. And then we're going to go into moving averages. This is like a very basic indicator, and you'll see that it's very powerful, very important. And then I'm going to go into some other indicators that have proven to be very successful and consistent in helping you define or find trading opportunities. And then we'll do a trading setup together with those indicators to show you how they work and how to use them. And then after that, we'll touch on options. So we're just going to do basics of options because that's another vast area that you can get into. but just so you understand the basics, we'll get into that. All right. So why do we want to invest? So let's say you're a millennial and you decide to invest $250 per month in an S&P index fund, starting at a young age, let's say 22. And this is something I wish I had done when I was that young. I had no idea about these things. And $250 a month is not a lot of money. And it's something that you can do consistently. It's only about $3,000 a year. And if you can do that every month, and you should already be doing it, like I said, in a retirement account, you should be able to get an average return of about 10% a year without any problem. So that's really a no-brainer. So the question is, how much money would you have 10, 20, 30 years down the line? And if you look at the green line down at the bottom, let me turn on my laser pointer. So by the time you're 52, without really even thinking about it, you'll have $500,000. And then by the time 62, if you want to retire at that point, you'll have $1.4 million. So that's pretty decent. Nothing wrong with that. But what if you get a little bold and you think you can get 15% return? Well, then you could certainly retire 10 years earlier. You could see this chart here. This is the 15% return a year. You'll have $1.4 million at 52. And so that's a pretty big difference. And so this is maybe one motivation to do some technical analysis and figure out, or try to boost your returns. Now, there's nothing wrong with doing buy and hold, which is what we're talking about here. It's really a no-brainer. You can just dive into this and not even think about it, and you'd have pretty good returns. But if you really want to increase your returns astronomically, then technical analysis is one way to go. So Arjun, I guess if there's questions, you're going to be the moderator, and just let me know.
As they come in, I'll go ahead and ask them.
Okay, so technical analysis, what is it? So basically, it's a trading discipline where you identify trading opportunities, looking at patterns, price trends, charts, support, resistance, that kind of stuff. And then at another level, technical analysis allows you to get into the mind of the market, to kind of anticipate what's going to happen next based on historical patterns that have been observed. So really, you're going to use TA to get an edge in the market, and that's very important. You don't want to trade unless you have an edge, and you don't want to trade until you have like a high probability setup. And that's what we're going to try to do here. So the other aspect is, you can compare technical and fundamental analysis. And, fundamental analysis that we're all kind of familiar with. Okay, we're going to look at, the company's earnings. We're going to look at their bottom line. We're going to look at their top line. We're going to look at what kind of industry they're in. That's all good. But technical analysis, you're going to dig deeper into how the actual stock price behaves. Is it, when there's good news, is it trending? Is the stock price trending up? Is it trading in a sideways channel, that kind of stuff? So technical analysis, you're going to use all these items here. You're going to basically move off, do everything off the price chart, and then try to identify patterns, support, resistance, and then use that to your advantage. Now, typically, most traders will also look at fundamental analysis, but on a broad scale, like, okay, what are we trying to, achieve? Are we going to look at stocks that are in an industry that's growing, like cloud, for example, or stay-at-home stocks like Zoom? So that kind of thing is more fundamental analysis, but it helps your technical analysis. All right, so I think we can just start with start with the nitty gritty here. We don't want to leave anyone behind. A lot of you already know what price charts look like, but for those who don't, basically each price chart will have these types of bars on it. And what I'm looking at here is this one's called a candlestick. So this one candlestick represents the range of price. Like say, for example, if this was a daily candlestick, this represents the price throughout the day. Where did the price open? Where did it close? And what were the highs and lows in between? Now, if for that day the price closed higher than it opened, the price chart will show a green candle. Conversely, if the close was lower than the open, then the candle is going to be red. Now, this is the body of the candle here. This represents most of the price action throughout the day, what took place in this range. So, just the color is just a little visual indicator of what happened that day in terms of open and close. And then the other thing I want you to take a look at is these are called the wicks, these lines below the body and above the body. So that kind of tells you that the price, was in that range, but it didn't stay there too long. It closed within the body of this candle. Now, a simpler version of that is just the open, high, low, closed price bar, which is just basically composed of sticks. This is also a common price bar that you'll see on price charts. But it's basically the same thing, nothing. I find the candlestick more useful. It gives you a better visual impact. Any questions on that?
Don't see any questions yet.
Okay. All right, so let's dive into a price chart. So basically what you have is that you have a overall price chart. This is in Thinkorswim. That's the platform I use. You have your time axis, horizontal scale on the bottom. On the side, you have the vertical axis with the price. And I've shown right here, like the stick type price bars. And very simple. This is a daily price chart. So you can see that, the price is kind of zigzagging, meandering through. You can't really tell much of what's going on. I went ahead and also put a moving average in. This is a 21 period moving average. You'll see in a little bit that this becomes very important. But let's just take a typical price bar here. This is this little line is the opening. And this is the full range throughout the day, and that's the closing. And you can see that it was above its moving average for that day. Now, the price charts on any time frame will look very similar to this, except this one says daily. This is up until August, but I can scroll back and it'll go back 3 years. But each bar here represents one full day of price action. But you could plot this for 30 minutes, 1 hour, 2 hour, 3 days, 1 week, just so you can maybe take a look at different types of patterns. So now here's a candlestick version of this.
And Abinash Uncle, just to clarify, this is all for one individual stock performance daily for a certain period of time, correct?
Yes, yeah. So this stock happens to be PayPal. And this is the price action since August up until last week.
Awesome, thank you.
Okay. And each one of these represents the daily range of price. So for example, this bar here is green. That means the close was higher than the opening price. So the closing price is considered like an important price because that's the close of the day. So whoever, if the bulls won that day, that means you had a green candle because they closed higher than the open. And if it's a red candle, that means the bears had kind of a winning day in the sense that they were able to drive the price lower than the open. All right. All right, so let's take a look at moving averages. So this is like one of the simplest indicators you can put on a chart. But essentially, you'd notice that all those price charts have a lot of noise. There's lots of price action back and forth. So moving average is a way to kind of filter out that noise, all that short-term fluctuation. And you can plot it in any specific time period, but what I use in my trading is 8, 21, and 34 days. Now you can use many different, there's 10, 20, 30. So, there's lots of different ways you can slice it and dice it, but this seems to work well. And I've read about it. A lot of other traders also use these numbers. But basically, you think of these moving averages as guide rails on your chart. All right, so as the price moves in and around them, it kind of gives you an idea if price has gone too far away from their mean. And one of the things you need to learn as in technical analysis is that price will want to revert back to the mean. And so you want to use these moving averages as a mean that the price is going to tend towards after a while. So there's two kinds of moving averages. One is a simple moving average, and the other is an exponential moving average. So simple moving average is just like it sounds. You're just taking an average of a range of a selected range of prices, and then you're just plotting that average under that one day. Exponential moving average, on the other hand, gives the most recent price more weighting. And that's a little better because it helps you anticipate what's going to happen a little quicker than a simple moving average. So EMA is what I like to use, but a lot of times I'll put both SMA and EMA on the same chart. Okay, so before we get to the next chart, what I mentioned earlier, prices eventually revert to the mean or moving average, especially the 21 EMA on a daily chart, as well as other time frames. So when you see the price go too far away from the 21, you know that, okay, now's a good probability it's going to come back. So, you use that kind of guidance from the moving average to help you make decisions. So once you have all three of these, the 8, 21, and the 34, and a few others if you like, you can look at what's happening with a trend. When these moving averages are stacked, that's when you know that you have an established trend. If they're stacked, when the 8 is above the 21, which is above the 34, that means it's a bullish trend. So it's basically just telling you right off the bat, there's nothing to think about. It'll tell you visually that, hey, you have a trend here. Okay, so let's take a look at this, is what it looks like on the chart with all three. So you can see you had a really nice stacked pattern here. So the red is the 8 EMA, yellow 21, and 34 for the blue. And you can see how it's interacting with the price. So you can see the price got really sloppy here, where the moving averages crossed over, and you couldn't tell what's happening. There's really not a trend here or anything, but there's definitely a trend here because the moving averages are stacked. And even here, when there's a little bit of a sideways action, the moving averages are still telling you, hey, the trend is intact because the averages are stacked. All right. So the other thing to note here is that a lot of times price will respect the moving average. So for example, the 34 EMAs right here, you can see how well the price bounced off of that. Like it knew it was there because a lot of traders follow these. So they do automatically tend to be support levels, or in some cases, resistance levels. So over here, you'll see that the 8 EMA became a resistance level. So the price had a tough time going over that. All right, so this is what I was talking about. So the moving averages kind of become like guide rails. It kind of gives you an idea of where the price is going, where it's been, how it's behaving. All right, so the next indicator I want to talk about, and we're just going to kind of build on these slowly, and it's just a few of them, is Bollinger Bands. And not too many people really like to use Bollinger Bands, but I find them to be very powerful. And the reason is it's that it does a statistical average of the price. So in other words, it measures the volatility. I don't know if you guys remember standard deviation from your statistics classes. You don't need to know the formula. You just need to know that, it can be used here. But basically what it's doing, it's measuring the volatility of the price. If the price is moving around a lot, then the Bollinger Band is going to be much further away than the average price. So the way we want to use it in the chart is that we want to use this 2 standard deviation Bollinger Band. That means that this band is going to be sitting 2 standard deviations above the price and 2 standard deviations below the price. Basically, 2 standard deviation means that 95% of all the price data is going to be within these 2 bands. If it goes outside that band, then that's an anomaly, and the price charts are telling you something there. Okay, so let's take a look at what that is. So here's the same chart. Now it's got the Bollinger Bands. So the Bollinger Bands tend to be very dynamic. You'll see they start to flare out. In some cases, they're starting to come back in. But basically, like the statistics said earlier, 95% of all the price has to be within these bands. Anytime you go outside the band, it's a little bit of an anomaly, so the price will want to come back in. So that's one clue. When the bands are narrowing here, that means there's less volatility. Maybe there's some consolidation in price, but it might even portend that another move is coming. And that's where we're looking for an edge to try to predict what's going to happen next. All right, so let's go on to the next indicator, the Kellner channel. So the Kellner channel, it's just a simple average of the average true range. So remember we were talking about the candlesticks earlier? Well, each candlestick represented a price range for that one day. What the Kellner channel does, averages all those ranges together for like the past 20 days, and then plots that as a line above and below the average line. So, and the way we want to use this, we want to use 1.5 times the average true range. And we'll plot that above and below using a simple moving average. So this is what that looks like. Now, again, this just looks like a little channel, no big deal. It's not as dynamic as a Bollinger Band, but it is taking into account the average true range. And so that is important, and you'll see why. And you can see over here in a nice trend, the price tended to stay above 1.5 times its average true range. So that means it was a pretty powerful trend. All right. So here's the main indicator that I use, and it's extremely powerful, and it's a combination of the last 2 indicators that we just talked about to create this 3rd indicator. So it's called a squeeze indicator, and basically all you're doing is you're plotting both Kellner channel and Bollinger Bands on the same chart, and it generates a signal when the Bollinger Band compresses or squeezes tight enough to fit inside the Kellner channel. So this means that there's suddenly a reduction in volatility, and then there's price consolidation. And so now the price is starting to move in a much more narrow band. And it's kind of like what's happening is it's a calm before the storm, and it's just energy coiling up in the price of that stock. And that is a good thing to understand beforehand, because maybe you want to get in on this pattern before it releases the energy, or what they call before the squeeze fires and the stock takes off. And then the question becomes, which direction is it going to go in? And then you want to take a look at your moving averages to help you understand what direction. Any questions yet?
No questions in the chat so far.
Okay. All right, so here we go. So this is the squeeze indicator. So we got the Bollinger Bands, we got the Keltner channels, we got the 3 moving averages. So you can see when you get to a squeeze, so I got the Bollinger Bands coming just inside the Keltner channel, and it predicted that there's going to be a huge trend, not a huge trend, but there's going to be some release of energy as it comes out of that area, and you have price expansion. It happened here again. So this was a definitive indicator. You had basically, when you look at a squeeze, you want to see that you have at least 3 bars, 3 price bars where the squeeze is in place. So that would be over here. And after that, you want to look at, do I have stacked moving averages where the 8 is above the 21, which is above the 34, and all that's true. And that's where you would be able to take that trade. That's, in this case, you'd say, okay, this is a upward trend, so you would go long on the stock. And you can even do it sooner than that. Before you have an official squeeze, you would just call it that it's a low compression squeeze, maybe out here and over here. There's a lot of information on this chart, so I don't know if have any questions. But the other thing you want to take a look at also, and I didn't talk about it much, is these volume bars here. So essentially, this little line is just the average volume for the past 50 days. And each one of these bars represents the volume for that day. If it's green, that means the price was up that day. And basically what you want to see is anytime the volume bar is above the average line, that's a bit significant. So for example, right here, as the stock price started to break out of this trend, it went up with higher than average volume. So that kind of confirms that you're having a price breakout. And it just gives you another indication that there's something happening there. So you guys have probably heard of this company, Tesla. Well, it responds to squeezes, as it turns out, very nicely as well. I was lucky enough to catch this squeeze right here. And you can see that this squeeze lasted about, I don't know, 2-3 weeks on the daily chart, which is pretty good. But it was good for, depending on where you got out, it was good for 100% return. If you were brave enough to hang on, you could have done much better. And that's just not even doing any options. That's just buying stock itself. So the Thinkorswim platform actually has a built-in indicator that does all this for you in terms of finding a squeeze. And it's called TTM_squeeze. And that's this indicator right here. So I left the original Bollinger Band and Keltner channels in here so you can see when that squeeze happens. And you can see the way this indicator works is that it will give you red dots along this line. This is the 0 line. And when you see red dots here, that's when the squeeze occurred. These bars above and below that line are momentum indicators. So, and they're actually very helpful because they're telling you which direction the momentum is of the stock. And for example, right here, you could see them as the light blue bars basically telling you that's bullish momentum. Anytime the bars change color, that means the momentum is fading. But you could have followed this momentum all the way to here and still done very well. Another thing to look at here is that you're not always going to get clean signals. There'll be cases where you see that the moving averages are stacked, but the momentum bar here is showing that it's going lower. So in a case like this, you want to wait to see if the momentum changes. And this is like a perfect moment when the momentum shifted from red to yellow. That would have been an ideal time to get in because you still had stacked moving averages so that the trend is still bullish, but these momentum bars actually told you the right time to get in. So this Tesla is one of the stocks that really responds well to squeezes. And you can see that even in different time frames, this is a 30-minute chart. So in a 30-minute chart, each bar here represents 30 minutes of data. And this goes back a couple of weeks. And you can see, there's squeezes all along here. And whenever you have clean, stacked moving averages, those are the best times to get in on the squeeze. Okay, so here's some rules for the setup and entry for the squeeze. So you need at least 2 price bars for a good squeeze, maybe more. What you need to do is go back and take a look at the price history of that stock and to see how it responds to squeezes. And sometimes some of the stocks only give you maybe 1 or 2 bars before they take off. But ideally, you want to get like 6 to 8 bars or something like that before you take the trade. Look for stacked moving averages to establish the trend. And you could also do this in a bearish trend if the squeeze is bearish if the moving averages are flipped. So exiting the trade is also very important to know when to do that and how to do that. So in the case of the squeeze indicator, it's actually kind of nice because it starts to change, the momentum bars start to change color, so that gives you a good indication of when to get out. All right, so that kind of wraps up the indicator, and I just wanted to talk about that one indicator because it's been so consistent. Any questions on that?
If you haven't asked them in the chat, feel free to ask them now. Abinash Singh, there's no questions there now, so I think we can. Oh, nope, one came in. All right. What are some things to think about when choosing a trading platform?
Okay, so you want to choose a trading platform that has lots of free tools in it, and Thinkorswim is one of those platforms. I think one of the other things you can look at these days, of course, is commissions, speed of execution. There's a bunch of good platforms out there, but I like Thinkorswim. Their E-Trade is good. Fidelity, a few others. I think Interactive Brokers also has a very nice platform. But for the most part, I've been using Thinkorswim. I'm pretty happy with it. Now, if you want to trade options, Thinkorswim platform actually has a bunch of good tools to help you trade options as well, to help you do analysis of options. All right.
And someone is asking your thoughts on Charles Schwab.
I haven't used Charles Schwab, but I believe they merged with E-Trade. If that's the case, then that's good. E-Trade has a really good platform as well.
Awesome. Next question is, can you please clarify the difference between support and resistance levels?
Sure. So let's go back to, all right. So support is where your price won't go below a certain level, and that level is called a support level. So that's an area where price repeatedly comes back to, but then is deflected away from above. So that's a support level, and those are very important to identify those. And that's one of the reasons why you have moving averages, because they will act as support and resistance. And resistance then is conversely, it's kind of like a ceiling overhead where price has trouble going through. I mean, eventually it can be broken. It happens all the time, but like if it happens once here, this is the 8 EMA, it's probably going to happen again multiple times. So you know that the 8 EMA has some significance as resistance or support. So it'll help you, time your entry or time your exit.
Awesome. Thank you. Those are all the questions that are in there for now.
All right. Okay, hopefully I didn't confuse everybody. But so next thing is we're going to dive into options. Now, options are a great leverage tool. So when you use a leverage tool, it's going to cost you a lot less than the underlying security. Now, so options are also traded on commodities, futures, and all these other instruments as well. And a lot of these techniques, by the way, like the squeeze indicator, can also be used on any price charts, even cryptocurrencies, commodities and futures and that kind of stuff. It works in anything that trades. So the advantage of leverage is you can benefit from the move in the underlying security with a lot less money. And so that gives you the leverage. Of course, it comes with its own risks because you can also lose money at the same time. So you want to have, you want to have technical analysis, and you want to have strategies under your belt before you engage in trading options. So basically, an option is defined as a contract that gives a buyer the right, but not the obligation to buy or sell the underlying asset at a specific strike price by a specific date. So important things to note here is that options have expiration. So they expire by a certain date, and they have a strike price. So that's the price that you're allowed to buy or sell the underlying asset. Okay, so a lot of people actually just trade options on their own, not with the underlying asset, because options move, as I said earlier, they move with the price of the underlying asset, but their move is very exaggerated. So when you buy or sell an option, you're basically you're controlling this contract for a short period of time. When I say contract, usually one option is controlling 100 share of stock. So even though the price of the option is shown per share, when you buy or sell it, you have to do it in 100 share chunks. So there's lots of different option strategies based on, whether you expect the market to go up, down, sideways. You kind of have to choose a strategy that fits that. So anytime, before you even trade options, you're really trying to understand what's happening with the stock or the underlying asset. And once you know what you want to do with that stock, then you can look at the option strategy. This is kind of long-winded, but this applies to calls mostly. So if you're a buyer of the option, you pay a debit, and that means you control the long option until expiration. So you're basically buying the right to purchase a stock at a certain price. And the goal is to just kind of utilize their leverage to profit as the underlying moves up. if you sell an option, basically what you're doing is you're collecting premium. So basically, you're actually this buyer here is getting the option from this seller on this side. So this buyer has the right to purchase a stock, and this seller has the obligation to sell that stock. So the goal of the seller is to collect premium and hope that by the time of expiration, that the value of the option is zero. So I have to tell you that most of the options expire worthless. So you have to be very careful if you're a buyer of an option, and that you could lose all your money. So for that reason, a long-term strategy is better to sell options than to buy them. But there's plenty of opportunities both ways. But long-term sellers make more money. So this is just more definitions of what an option is. So put option is an option or contract that gives the buyer the right to sell the underlying asset at a strike price at any time up to the expiration. So, if you buy a put option, you expect the price of the stock to go down. And as that price goes down, the price of the option will go up. So that's how you would gain from that. And it's just the opposite with a call option. Call options are very, very common, especially this year. There's been a huge amount of trading activity in call options. And just to give you an idea, there used to be, the past few years, there used to be, I think, like 15 to 20 million option contracts traded a day. And now we're close to 40 million options contracts, which is just ridiculous. So there's a lot of activity going on in the market. People are betting lots and lots of money that the market's going to keep going higher. So there is a lot of activity there. There's a lot of liquidity in the market. So call option, essentially call option is just a contract that allows you to buy the underlying asset at a certain price. And you benefit from just buying the call option when the underlying is going to rise in price. So here's what all that means. You're going to go long calls when you're a buyer of options, you go long calls and you're expecting the underlying to go up. Also, if you short puts as a trader, you're selling the option, you're still expecting the underlying to go up. Next time around, I'll go a little more deeply into selling puts, because that's actually a really interesting strategy. Long puts, like we talked about, you're expecting the underlying to go down because you're buying the put. And then short calls, this is the riskiest strategy on the planet. You never want to do this by itself. It's selling a call because you essentially have unlimited risk. Okay, so there's a lot of jargon that's associated with options. And so let's go through that quickly, because we don't have to do like a deep dive into every one of these, but just, we'll just discuss them in like a overview style. So an option delta. Delta is basically amount the option price will change based on a stock price. So for example, a delta of 50 means that if, let's say you have a stock that's $100 and the option price is $5. So if the stock price goes up by $1, because the option has a delta of 50, it'll only go up by 50 cents. But now you're talking about a $5 option going up by 50 cents versus a $100 stock going up by $1. So there's a big difference. That's where the leverage helps you. So if a option has a delta of 90, that means it's going to go up 90 cents for every dollar the stock price goes up. So that just kind of gives you an idea how the options are moving in price relative to the price of the stock. Theta is how quickly an option value declines. So the price of an option actually has two components in it. One is the intrinsic value and the other is extrinsic value. So the extrinsic value is the one that has theta. It's normally referred to as theta decay. So that's the value of that is when you see a number that says theta, it'll be like a number, say 0.3 or negative 0.3. So that means for 100 shares, you're going to lose $30 a day on that theta. So that there's price in the option that decays every day. And that's one of the reasons why it's better to be a seller of the option rather than a buyer. If you're a buyer, you're going to experience that theta decay every day and it's going to go against you. Strike is what we talked about before. That's the price at which option is bought or sold. In the money, at the money, out of the money, those are all locations of the strike price. At the money is a strike price that's same as what the current stock price is for a call option. Out of the money is, so say that the price of the stock is $100. That means the out of the money strike price would be anything above $100. In the money would be any strike price below $100 for a call option. And then it would be opposite for a put option. So implied volatility is just the expected volatility of the options until expiration. So one thing to note here, as a company gets close to its earnings report, the implied volatility, that's what the expected move is in the stock price, starts to go up. And hence the option prices tend to go up. It doesn't necessarily mean the stock is moving, but the option prices start to increase. And that is one time you want to be a buyer of options, is when the volatility is increasing. And you could, and I've noticed this before, the stock price doesn't even move, but your option price will jump up just because the volatility has gone up. So that's one of the ways you can benefit from an earnings report. You don't want to hold into earnings. What happens is the day of the earnings or right after earnings, the volatility collapses. And, so that's a different way to play that. There's different ways to play the collapse in volatility.
Abinash, we have a question in here for you.
Sure.
Do you have to own the underlying asset to sell the option?
So you can buy and sell options without having the underlying asset. You can definitely buy and sell calls. Well, you can buy calls, you can buy puts without having any underlying assets. You need a lot more money in your account. If you want to sell puts, you'll need to have enough money to be able to buy the underlying asset in case it gets exercised. In other words, in case it gets assigned to you. And don't even think about selling naked calls.
Perfect. Thank you.
So options don't exist in the market until somebody actually goes in and makes a trade. That's different from stocks, because stocks are already out there. There's a float of stocks, there's shares outstanding, they exist. But options don't exist until until a buyer and a seller come together and they create a contract. And when that happens, that's one open interest. So that's the definition of open interest. is how many contracts are out there, how many contracts are created. When a buyer and a seller, do one transaction, and then they go ahead and close that transaction, so that'll be a volume of 2. That means 2 shares or 2 contracts were traded. But again, it's different than an open interest. Open interest is really how many contracts exist at any one time. All right, so let's look at an example of how we could actually use options trading combined with some technical analysis. So here's a stock, Paycom, and I'm not even sure what they do, but they're in the cloud space, and I guess they're a software company for human resource management or something like that. But really, that's not that important. What's important is, okay, they're in a space that's growing, and the stock has done very well. But we are trying to figure out an entry point. So what do we take a look at? Well, we'll take a look at the squeeze indicator. And you can see that we have a squeeze forming here. You got about 8 bars, but you got negative momentum. If you look at the moving averages, they're stacked pretty nice. So you want to take a bullish trade. And you notice that here on November 20th, that the stock actually closes above, or it's about to close above its 8 EMA, which is a good sign. That means it's showing a lot of bullish strength. So you figure that, okay, stock price is on 392, closing above its 8 EMA, maybe you want to take a trade. So how do you decide if you want to do an options trade? The easiest thing you can do is buy a call, because that's a bullish thing to do. So let's take a look. So what you want to do is you want to look at an option chain. An options chain basically lists all the strike prices that are available for you to trade. So this is an options chain in Thinkorswim. And so let's just take a look at it at the top. So I went back in time and I pulled it up this is for November 20th. And that's something that you can do in Thinkorswim. You can go on demand and you can go back in time up to 10 years or something and bring up data. So that day, November 20th, the stock was around 392, and you decided that you want to do a delta 50. So if you look at, let's look over here. This shows the date that the options expire, 18th December. These are the various parameters of the options. Here's the deltas. The deep in the money options have a delta of 1. That means they move in lockstep with the price of the stock, except they're also very expensive. You could see that this is the bid and ask price for them. But what we want to do is, to get the best bang for our buck, we want to do something that's a little bit in the money. So let's say we take the one that's just in the money, that price of that stock, that strike price is 390, and that could be bought for about $19. So that one's in the money. And the reason you're getting this is because you're expecting, because of the squeeze, you're expecting the price to go up, right? Because this is a high probability pattern, and that's why you're taking this trade, is because it's high probability. And it's a setup you're familiar with. So what you do is you look at the price here and you set up a trade. Let's say, because the bid and ask, that's the spread between what you can buy it for and what you can sell it for. If you want to buy it immediately, you have to pay about $20. If you want to sell it right after that, you have to pay $17.40. But typically you can, when you want to buy, you can get a price somewhere in between. So I picked a price of 19. I didn't actually take this trade. I took a more conservative trade. So in this case, let's say you were able to get a price of 19. That's $19 per share. So you actually have to do, remember I said this is 100 contracts, it tells you right here, 100 share contract. So you would have to buy it for $1,900. Okay, that's fine. And sure enough, right, we've seen the price go up after that. And this is a close just yesterday. It closed at 437. So it went from 392 to 437. So $45. Pretty good move. So what happened to the price of the option? So the option went from $19 to $48. You can see right here, this was yesterday's price. 48 because that's kind of in between the two. So what does that mean? So you're able to sell it that day, and you can take a look at the analysis here. So you took the trade because you had a setup with a squeeze, bullish momentum. You did the December 18th expiration. Now December 18th still a week or two away. So you can, you still have time to hold on to it if you wanted to. But nothing wrong with taking profits early. So what you did is you bought one call, 390 call for 19. You sold it for 48. Your profit was $2,900. So that's a rate of return of about 152%. So that kind of shows you the advantage of using an option. Now, the reason you would use a call option here, even though they're very risky, is that you had a very high probability trade. And if you don't feel confident, then you would not want to just buy a call like that, because if the price of the stock didn't go up by $19 from that point, then you would have lost all the value in that call option. So that's the inherent risk that you have to be cognizant of. So if you just bought 100 shares of Paycom at 392 and then sold it at 437, that's a pretty good profit. You would have made $4,500, but your rate of return, the amount of money you had to put in, is $39,000. It's a big chunk of change. And you would have gotten 11.4%. That's not bad. But doing the call option, you got 152%. Now, is that going to be the norm each time you do call options? No, it's not. But one thing I'll say about the squeeze indicator is that it's usually, with using it with the trend following system, like moving averages, it's good about 70% of the time. But again, there's a lot more to it. It's like also when do you exit the trade and so forth. So there's still a lot to cover there. But I just wanted to give you a flavor of what option trading is like with technical analysis. And so this is kind of the overall how you put the whole thing together. All right. So so basically I only just covered this one strategy, which is long calls, but that's a directional strategy. There's lots of other strategies, and I'm not expert on all of them, just a few. I do debit spreads and credit spreads. These are more conservative strategies, which I like to do. I've done a few butterflies. I know they have all these odd names. And then there's neutral strategies as well. If you don't expect the stock price to go anywhere, if you just expect it to trade in a range, there's strategies for that, like iron flies and iron condors and straddles and that kind of stuff. And there's also a really good strategy that I've been using. It's called selling naked puts. If you wanted to buy a certain stock, but you want to get paid for the privilege of buying it, you can sell a put on that, and you'll get paid a certain amount of premium that you get to keep, and you'll get also be able to buy it at a good price. So if you want, at a later time, I can discuss these strategies further if there's more interest. But there's lots to learn out there, and some of these are very powerful strategies once you understand how to use them, and use the proper techniques and learn the technical analysis behind it.
We have one more question in here for you.
Sure.
When does the option contract expire? During close or open for the selected expiration dates?
So the expiration date is on a lot of stocks these days is every Friday, and you can select some of them have monthly expiration dates. So monthly expirations are third Friday of the month. Majority of the stocks have that, but then stocks that trade that have high volume, a lot of liquidity, they also have a weekly expiration. And it's kind of nice because it gives you so many options on to select a strike price and expiration. If you feel like the move's going to take a while, you can, stretch out the expiration to months or even a year, year and a half out. Of course, you have to pay a lot more for that option because it has a lot of premium built into it. Or you can do weekly options. And what I like to do is sell put options every week because the theta decay on those is very quick on a weekly basis. Okay.
Perfect. Thank you.
So closing thoughts. So this is just, like I said before, just scratching the surface on all the different strategies that are available in technical analysis. So the squeeze indicator to me is like a very foundational type of technical analysis. I always look for that before I do any kind of trading. I always look for that indicator to show me a signal. So options are inherently risky. You don't want to trade them without actually learning risk management techniques. There's like a whole set of principles that you have to learn before you can start trading options. There's also a lot of psychological or psychology that goes into trading, and it can affect, how you take profits, whether you cut your losses quickly or whether you let it drag on. And so, that's a large aspect in trading that people kind of ignore, but it's very important.
Another question in here for you.
Yeah.
What books do you recommend to get better at trading options? What about online resources?
Yeah, so on my last slide, I have a list of resources. And then,
Perfect. We can look at those then. There's another one in here for you.
Mhm.
This seems like a decent amount of time to commit to investing. How do you balance that with the lower return, more passive investing strategies?
Right. So for most people, I would recommend that you don't even go down this path because you can get fairly good returns, like I said in the earlier slides. If you can get 10% return, but now the issue is how much time do you have? Uh, if you don't have a lot of money to invest and you don't have a lot of time, to make that investment work for you to get good returns, then options and technical analysis gives you a method to grow your account quickly. I mean, it definitely, takes some understanding, some training, some learning, but then, if you have a quote here from Warren Buffett: invest in yourself as much as you can, as you are your own biggest asset by far. So I look at it that way because there's lots of traders out there that maybe trade one or two stocks and they just trade one or two different indicators and they can make a living doing that. Now, I'm not in that boat. I'm not in that camp. I just I just do it a little bit on the side. And I'm thinking, once I retire here in 2-3 years, I can do this more regularly. And the point of doing all this investing really is to, take your profits and do something bigger with it. Obviously, is to, go out there, invest in memorable experiences, go out there, invest in assets, go invest in your community, into certain organizations that you believe in, charities. And that is the main reward that you're going to get out of doing this.
So going off the first question, how much time do you spend on a weekly basis checking in or executing your trades?
So I have a full-time job, so during the day I don't actually have that much time. But in the evening I may spend like maybe half hour or something like that checking in to see what's going on. And so that's why I only focus on one or two indicators, like the squeeze, because it's easy. I can run a scan on the platform, which will tell me, which stocks are in a squeeze and maybe that they have the right type of pattern that I'm looking for before I take a trade. So not a lot of time. And I trade maybe once a week, sometimes twice.
And what news sources do you typically use to get market updates?
So I actually don't look at a lot of news on. Okay, so I mean, I do watch CNBC from time to time. I use them as a news source. Here's some additional resources, but one website I do go to is finwiz.com. It has a subscription service, but their free service is pretty powerful. That has lots of charts, diagrams, news, blogs, everything in basically one site. And then CNBC and CBS Market Watch is another one. So these are some of the other resources that I have used in the past, or sometimes still use. Option Alpha is a good website to teach you options trading. If you're really interested, there's a podcast called Chat with Traders, and it's actually a really good resource because they have interviews with world-renowned traders, and these guys will come on these podcasts and they'll talk about all the strategies that they're using. There's all kinds of traders out there, but it's a very useful, helpful. If you got some time, you want to listen to a few of them. There's also this guy Ripley Coleman. I discovered this guy, I don't know, a few weeks back. He talks a lot about the squeeze. So if you're interested in finding out more how to use the squeeze, you should check out this guy on YouTube. Psychology of Trading, Trading in the Zone, that's a good book. All these books down here are good. Of course, I also do subscribe to Stock Advisor. So Arjun, if get any more subscribers out of this, maybe you'll get a commission.
Sadly, I don't get a commission, but do check out the Motley Fool if you're looking to get more information on what brokerage accounts to use. You can also check out the Motley Fool Ascent, and they can help you make some better decisions.
Yeah. Cool. So these are, I wouldn't say this is the exhaustive list of resources, but these are the most helpful resources that I know of.
Thank you, Abinash Uncle. If anybody has any more questions, we're happy to take them now. There is one in here for you. Why don't you trade full-time as a job?
Because I'm still learning trading, and it's like a process, like with anything else. You go to school for many, many years to learn the trade. So it's not something you can learn overnight, but you can certainly learn a lot in a short period of time, and then you start to go through the process. Like I was saying earlier, think of it as a whole process and not just about making money, but it's like learning the setups, learning to look at identifying support, resistance, and taking it from there.
Well, thank you very much, Abinash Uncle. We really, really
Pleasure.
appreciate you doing this for us. I've been personally trying to learn options trading for a long time, and you truly made it easier to understand than almost anyone has ever done before. So I really do appreciate that. For everyone who has attended, thank you so much for coming. We hope you liked the presentation, and look out for information for the third part in the series with the Sikh investors.
Yeah, so I just wanted to add, if you guys have any questions that you think of afterwards, you can certainly email me.
Or reach out to anyone at SPN, and we can forward
Yeah.
the questions to Abinash Uncle as well.
Yeah. So if you're interested, I can do like a second part on options, or if you guys want to delve a little more into technical analysis, we can do that. And in Singvestors, we have other experts, and they can come aboard and do the presentation if need be. Okay, so we're happy to help. And I think in the future, we're trying to develop our website. So we're going to put a lot of information there, and maybe even start a blog, and where we can put timely updates of what we're thinking of doing or what trades we're taking, that kind of stuff.
We're excited to see where the Singvestors go, and we are so happy to be able to work with them. Thank you, everyone, for coming out.
Okay,
Have a good
thanks
rest
a
of
lot.
your day.
All right, take care.